Good morning, everyone, and welcome to our DAT IQ Market Update. This is our update for Valentine's Day 2023. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and a very important guest this week to talk about a very important topic. We have Ibrahim Bayan. Did I say it right?
That's right.
Yes, nailed it. Welcome to the show.
Thanks. I'm glad to be here.
Good to have you. We've been wanting to get you on the show for a while. I'm glad we connected.
Yeah, I've been looking forward to this. What part of the country are you in?
So I'm based out of Atlanta. My company's headquarters is really in Charlotte, but I work out of our Atlanta office here, and I've been in Atlanta for about the last couple decades now.
Yeah, I'm sure you're getting much nicer weather than us. We're all flying to Chicago this week for a big customer visit, and we're going to be following the snow across the country. Do you mind giving folks a little bit of a quick intro to start the show, and then we'll bring you back at the end to talk through our question of the week? Sure.
So I'm Ibrahim Bayan. I'm the Director of Industrial Research here at Nuveen. And Nuveen is one of the largest asset managers in the country. We essentially go in and invest in commercial real estate, and I'm on the industrial side looking at warehousing trends. I spent most of my career sort of on the transportation side of things. I worked with UPS for about a decade, just doing economic analysis, helping them forecast things out. I joined FreightWaves right in the beginning of 2018 and worked there for a couple of years studying trucking trends. And I really made the transition to commercial real estate and warehousing in the beginning of 2020. I've been doing that ever since.
All right, that's a little bit of a hint at our special topic of the week coming up. So we'll bring Ibrahim back. But I'm going to get into our key points of the week here to get us moving. So before we get into the freight key points of the week, I just wanted to send some thoughts and prayers up north to Michigan State. They're dealing with a bit of an extreme tragedy up there. We have a lot of freight friends up there in Matthew Leffler and Jason Miller, just to name a few. So our thoughts and prayers are with them. We may be enemies on the football field, but we're all sending our positive thoughts and vibes up there to get them through this tragedy. So keep them in your minds. Let's get to freight. So dry van rates down, but they've been bouncing around the same level, for about 4 months. Dean's going to talk more about that, but pretty typical seasonality exerting itself. We won't see much in the way of rate directionality until we get moving into, I'd say, even early March. Flatbed is improving as spring approaches. We do expect that seasonally. The question becomes how much the housing market cramps the style of flatbeds as it moves into the spring. Intermodals to own long haul sector for loads over 1,500 miles. There's an interesting interplay that I'm sure Dean's going to cover that Ari Ash also writes extensively about in JOC amongst intermodal savings and how the two rate dynamics can play. That's something really important to keep in mind as markets are in transition. And then preliminary January imports are up about 1% month over month, but down 16% year over year and hovering right around 2018. 2018 is going to be an important year to watch as we move through this year. Just something to keep in mind. So I'm going to turn it over to Dean here to get us through our market update. Dean?
Yeah, thanks, Ken. Let's start off the market update with the load to truck ratio and dry van load post tracking closely, as you can see from the chart, along the 2018 levels. They were down 16% last week. Volumes are still up about 6% in the last month, though, and about 30% higher than the average for the second week of February, going back 6-7 years. Equipment posts, though, up last week. Capacity did loosen a little bit, identical to 2020 levels. And of course, that was a time when the market continued to shed capacity following the oversupplied 2019 market. Last week's load to truck ratio down slightly to 2.37. And in the refrigerated category, after a slow start following Hurricane Ian late last year, the Florida produce season is back on track. Weekly truckload shipping volumes are within 2% of last year. Didn't make much impact on national reefer load post volumes, though. They're about 12% lower. Capacity loosened also with 11% more equipment posts last week, still at the highest level in 7 years. As a result, the load to truck ratio down slightly from 4.88 to 3.73. And in flatbed, a little bit of a reversal to the other two. Flatbed load posts actually increased for the third week in a row, up 5% last week, and on track to follow prior year's seasonal increase through spring, as Ken mentioned. Volumes are still 30% lower than the 6-year average, and about half of what they were this time in 2018. Equipment posts also at their highest level in 7 years, and about 10% higher than 2020. The load-to-truck ratio down slightly to 13.20 last week. Having a look at our market condition index, starting off in the southeast, volume gains in Atlanta, number one spot market in the country last week. Volumes were up 3%. Outbound rates were up slightly by a penny per mile to $1.68. Remember, folks, these are line haul rates excluding fuel. Some of the regional markets in the Mid-Atlantic area, Charleston, rates up 10 cents a mile to $1.87. Some of the longer haul lanes were playing pretty well for carriers. Charleston to Kansas City, Missouri at $1.80 a mile. That's the highest since August. Our ratecast forecasting tool has got this up to about another 25 cents a mile in the next month on that particular lane. Houston and Dallas were the number 2 and 3 spots last week. Combined volumes were down though. Spot rates were flat at $1.69. Loads moved between Dallas and Houston. It's a very big lane in the spot market, almost doubled last week. These are loads moved, not loads posted. Capacity continues to loosen. Those spot rates hit a 12-month low on that lane at about $4.98 a load, which is about $2.06 a mile. Loads moved in the opposite direction were up 60% last week. A lot of volume moving between those two big cities. Rates also declined northbound to a 12-month low of about $2.14 a mile for the dedicated carriers that run back and forward between Houston and Dallas. The average round trip rate's about $2.10 per mile. It's about 34 cents a mile higher than the national average dry van rate. And this time last year, Los Angeles and Ontario markets consistently held down the number 1 and 2 spots for load post volumes. Last week, they barely made the top 20. At around half what DAT reported in Atlanta and Houston markets last week. Rates dropped 3 cents a mile to $1.67 in Los Angeles for outbound loads and to $1.79, down 6 cents a mile in Ontario. Having a look at the refrigerated market, obviously we've been covering the Valentine's Day event today. Surging volumes of flowers into the Miami market helped push state level rates up by about 26 cents a mile in Florida. Outbound average last week was $1.66. In Miami, which of course is ground zero for floral imports from South America, spot rates spiked last week, up nearly 30 cents a mile to $1.65. Long haul loads to Brooklyn, New York, Hunts Point produce market averaged $1.91. That's the highest they've been since June last year. Regional lanes, 670 miles north to Atlanta out of Miami, spot rates at $1.89 were almost 70 cents a mile higher than the January average. Michigan last week, spot rates increased 8 cents a mile to $2.75 for outbound loads, which is right around 2018 and 2021 levels. Most of the gains in Michigan came from Detroit, where rates increased 20 cents a mile to $2.16, while in nearby Grand Rapids, spot rates are up 6 cents a mile to $2.66 for all outbound loads. That's a 7-day rolling average. And having a look at flatbed, a lot of activity in the southeast, as we reported last week. Montgomery, the Montgomery market only just missed out on the number 1 spot for load post volumes last week. Houston was only slightly ahead. In Montgomery, volumes were up 4% last week. Rates up for the 4th week in a row, up by 22 cents a mile to $2.78 for outbound loads. Montgomery to Lakeland at $2.94. That's about 4 cents a mile higher than this time last year. In Houston, load posts were up 18% last week. Spot rates for flatbed loads are up 8 cents a mile to $2.30. One of the high volume lanes that we look at from Houston is out to Lubbock. Laredo was also a very busy lane. Plenty of capacity, though, on those two lanes. Rates were down. Loads to Lubbock in the Permian Basin were at a 12-month low of $2.55. Loads to Laredo dropped under $2 a mile for the first time in 12 months. And having a look in the Pacific Northwest, there was a surge in volume in Portland last week. Outbound rates jumped by 33 cents a mile to an average of $2.58, with capacity particularly tight on the short-haul lane north to Seattle, where it was about $832 a load. That's about $4.80 a mile. That's the highest it's been on that lane since June last year. And wrapping up our market update with our year-over-year look at spot rates, even though dry van rates dropped by 3 cents a mile last week, as Ken mentioned, they're still bouncing around within 3 cents a mile of this long-term average since over about the last 4 months, roughly. National average rate of $1.76 a mile is 6 cents a mile lower than this time in 2018, but 12 cents a mile higher than in 2019. And compared to our top 50 lanes based on loads moved, They averaged $2.01 per mile last week, 24 cents a mile higher than the national average. And in the refrigerated category, national average reefer line haul rates are following a typical cooling trend in the lead up to spring and increasing produce volumes. Rates were down 3 cents a mile last week. Also, the national average is $2.06 per mile. That's excluding fuel, about $1.04 per mile lower than this time last year, and about 11 cents a mile higher than this time in 2019. And lastly, in flatbed, spot rates actually increased for the third week last week, up a penny per mile at $2.10. Flatbed rates are about 6 cents per mile higher than this time in 2018, as that year's flatbed rally was just getting started. So that's it for this week's market update. If you want to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published this evening. And with that, it's back to Ken for the short-term rate forecasts.
Thank you, Dean. I'm going to coin a new term here. We got an agreement sandwich here happening with the short-term forecast. So let's get into it. So for those less familiar with our short-term forecasts, we start with dry van. These are national rates, long haul, dry van. The blue line is the 7-day weighted moving average going back to October 1st. And then we have 4 forecast models to share. We have the green one, which is Ratecast. That's in all of our products, the RFP tool, rates, Ratecast, all of that. We have the red line, which is the short-term forecast, which more heavily weights short-term data. So it tends to overreact in either direction. And then we have yellow and gray, which are blends of the two in various compositions to give us a view that's somewhat in the middle. As you can see, the models are pretty much in alignment for dry van. So we're going to see some strength heading into the middle of this month and then dipping down as we get into early March. What you can't see here is that these models are going to start to pick up on that spring seasonality on the other end of it, but not necessarily in the forecast horizon. The one thing to point out, it is the short-term model disagrees a little bit at the end, and that it's testing those lows that we saw before the final push and peak by the end of this forecast horizon. So let's get to reefer. Here's the disagreement, right? Ratecast has things middling about pretty much over the next 35 days. Not much movement, a little bit of a rally and then a dip, and then you'll really start to see that seasonality kick in. As we do the show each week, you're going to see more and more up and to the right happening with Ratecast because it's going to want to revert to that seasonal effect of spring shipping for refrigerated. The short-term forecast isn't having any of it. It's basically saying we're going to go all the way down and test that $1.80 a mile ultra long haul shipment level by the end of the forecast horizon. The blended models seem to agree, at least directionally, although not to the extent. So something to keep an eye on. And we have flatbed. As Dean mentioned, this one is a much more agreement than reefer, but maybe not as much as dry van. Ratecast expects continuing strength heading into the season. The short-term forecast is a little bit more pessimistic, most likely due to some of the weakness we've seen underperforming, I should say, seasonality over pretty much the bulk of the last 6 to 8 weeks. So again, these are our short-term forecasts. In the next couple of weeks, we'll do a refresh of our long-term forecast for the show, just to give you a bit of a perspective. So with that, we're going to bring Ibrahim back, and Dean's going to hit us with our question of the week.
Yeah, thanks, Ken. Very excited to have one of the leading economists in the country on the show to talk about what we're seeing in the warehouse market. So, Ibrahim, question of the week is, where do you think commercial warehouse development is headed now demand is cooling down?
Well, it's an interesting question. You know, I think to put it into some perspective, start by saying that like industrial and warehousing development and demand has been as hot as it's ever been, really since the onset of the pandemic. There was an initial hiccup like right in the first quarter of the pandemic. Since then, industrial's really been on fire. Record amounts of demand in the sector, just as companies scramble to try and find space to better expand their e-commerce operations. I mean, if you think about like what the pandemic did to just commerce in this country, in those initial quarters, everybody was forced home. Everybody was buying things online, and a lot of companies were caught flat-footed. They didn't really have the operations set up to scale their e-commerce fulfillment in the way that was demanded, and as a result, they've kind of been trying to scramble to catch up ever since then. Like there's been just insatiable kind of demand for industrial space. Now, the real challenge going forward is that historically, like, there's a pretty close tie between how the economy performs and how industrial demand performs, right? And so, like, as the economy cools, industrial demand tends to cool down as well. And we're certainly starting to see some of that. Like, if you ask me to sort of pin it down, I would say like the industrial demand peaked somewhere in the end of 2021 or beginning of 2022, right, and it's begun to moderate since then. I don't necessarily think that demand is going to completely evaporate. There's still like a lot of long-term tailwinds that help industrial demand, but I do think that it's going to cool off quite a bit from where it was. And the real challenge for the sector is that, like, on the supply side, a lot of developers have really been responding to that earlier surge of demand. So, like, what typically happens is demand picks up, there's low vacancy, there's high rent growth in the sector, and so developers take notice and they begin to build these more industrial space. And so when you look across the country, there are quite a few markets that have just like record numbers of new buildings that are coming under construction. And so you have this interesting dynamic of just like demand that's starting to moderate and supply that's beginning to pick up at the same time. And so what that means is that, like, in some of these markets, you're going to start to see vacancy rates start to creep up some. There's going to be more new supply than there is sort of people to fill it. And I think that dynamic plays out in quite a few markets this year. Now, with that said, keep in mind that right now vacancies are historically low. You're talking about nationwide, maybe 4% of all the industrial space that's out there is currently vacant, right? On average, like historically, that number might be around like 6 or 6.5%, right? So we're way below like historic norms for like the vacancy that's there. And so even if vacancy starts to creep up, it's coming up from these like sort of record low levels. And so I think the sort of the net of it is you're going to start to see some of these dynamics change. Like, it's no longer just a tightening industrial sector anymore, where there's more demand than there is supply and people are sort of fighting over space. You're going to start to see more supply than there is demand, and vacancy rates start to creep up. But by any historical measure, you'd still look at it and say, like, okay, this is still a pretty tight kind of environment. Like, there's still low vacancies, even if vacancies are trending in the opposite direction.
Right.
Abraham, I know this might be a little bit outside your bailiwick, but are you seeing any transition, whether it be geographically or in the makeup of this warehousing space, to satisfy the e-commerce boom? I mean, we're seeing it a lot in our part of the country along the I-80, I-90 corridors. They're building them as fast as they possibly can, and even getting down into that I-70 corridor down there.
Sure. I mean, there's a couple of things. One is it's sort of this idea of geography, like where people are deciding to move into warehouses. The other is just like how these warehouses look. So to answer the first part, like geographically, I think now the industrial sector is much more about like how close can you get to some of these population centers. Like if you were to look back, say 30 years ago or so, that wasn't necessarily the case. Like oftentimes you had industrial space sort of being built in areas where land was cheap, and you could throw up 250,000 square foot warehouse or a 500,000 square foot warehouse, and then have trucks take things to the final retail location, right? But now increasingly, like it's e-commerce, but it's also just like the speed of e-commerce, like the pressure to get things to the end consumer as quick as possible has forced companies to kind of think about locating these warehouses really close to major population centers. And so as a result, it's caused increased demand in areas that previously wouldn't have been all that interesting from an industrial standpoint. So if you took, for example, a town like Stockton, California. Stockton, California is a relatively small town in Northern California. And historically, like there's some industrial development, but not a ton. But over like the last 5 to 10 years or so, you've just seen that area explode because Stockton's pretty close to Oakland, it's pretty close to Sacramento, pretty close to San Francisco. And so by locating in Stockton, you get access to all these major population centers for e-commerce fulfillment. And so there's that part that's just like, trying to get closer to the end consumer. The other piece is just like how these buildings look, right? e-commerce fulfillment and the way that you sort of optimize an e-commerce warehouse typically requires like higher clear heights for these buildings. So that means that you need like higher ceilings in warehouses than you did in the past. If you look from say like, especially in this post-pandemic period, most of this demand is coming in just like newer spaces that are typically larger and they have like higher clear heights. So 28 to 30 foot clear heights or above. Is what would optimize you for e-commerce. Whereas like historically that really wasn't the case. And so, yeah, I mean, I think e-commerce has introduced a number of dynamics into this space.
So Ibrahim, one of our busiest lanes in the spot market is in fact Los Angeles to Stockton. And in fact, in our top 10, there's like 3 or 4 in Los Angeles. So we've seen a lot of growth in those markets on the spot market side, in particular markets like, Denver, Dallas, Phoenix is relatively close to a lot of those imports on the West Coast. But the other trend we're seeing is increasing truckload volumes along border markets in particular. So I just wondering, do you have some thoughts on how that, sort of nearshoring to Mexico is impacting warehouse capacity along, say, Laredo, El Paso, McAllen markets?
That's right. And I mean, I think this is part of just a broader industry response to supply chain disruptions. I think the pandemic provides a really clear example of like what a supply chain disruption looks like. But these are problems that existed even before the pandemic. So prior to the pandemic, we had like sort of the trade conflict with China and the disruptions that were introduced there. And I think companies just kind of looked around and said, look, we need to have production a little bit closer to where we are. Right. And so there's a broader movement that I think is just a macro trend of just trying to diversify the supply chain away from reliance on China, whether it be to other Eastern Asian nations or to Mexico and some of these neighboring countries. And of course, that has implications for just like warehousing demand. If you start to source more of your production from Mexico, then all of a sudden towns like El Paso make an awful lot more sense for having warehouses, right? Because that'll give you just like a place to store your goods right on the other side of the border, which may not have necessarily. I mean, Mexico's always been a fairly large trade partner for us, right? But as you get more interest in production coming from Mexico or from Canada, you'll get more interest in some of these towns that are closer to the border. So they're some of the fastest growing industrial markets out there.
Yeah, we're seeing a lot of growth in markets like San Antonio, for example, which are not right on the border, but kind of adjacent. We're seeing a lot of warehouse development there based on some of the truckload volumes we're seeing posted in that market, sort of much higher. In fact, over the last few years, we've just seen year-over-year increases in the volumes moving northbound across the border. And I think it's high 70s, maybe low 80s is the volume of freight that actually moves across the border by truck. So it's a very land-intensive freight task that seems to be just growing considerably.
That's right. And I mean, when you think about like warehouses and where they're being located, I think, closeness to some of these trade routes is important. Closeness to population centers is important. Ports and access to ports. So if you think about like a port city like Savannah, just massive amounts of warehouse development in areas like that. And then also just like some of the major international air hubs, right? And so this benefits a market like where I'm at in Atlanta, right? Where you see an awful lot of development around Atlanta. But yeah, like access to trade routes, access to major highways, access to rail, access to ports is really where you start to see more and more warehousing development creep up. And it's there's been an unprecedented wave of just like new construction in the space following this unprecedented wave of demand.
Right.
So I have one question, if you don't mind, before we get to audience questions. What are your thoughts on warehouse automation? I've been to a couple events and seen some presentations, and it's just remarkable to see all the little robots bouncing around and moving pallets. What are your thoughts on the long-term sort of adoption of those technologies?
It's very necessary for the warehousing space. I mean, one of the big challenges you have with a warehouse is trying to find somebody to find labor to staff it. And one of the things that a tenant will consider when trying to think about where they want to set up shop in a warehouse is sort of what's the available labor pool. And this is a challenge that, I mean, it's not just in warehousing. It's in, you guys in the industry also. It's on the trucking side as well. It's on the construction side. Like these, all sort of fighting over the same class of worker. These are workers that typically don't have like college degrees and things like that. But there's a very limited supply of that. I mean, with unemployment being as low as it is, it's very difficult to find staffing for warehouses oftentimes. And so automation becomes sort of one of the ways to try and get around it. The better that you can automate some of these warehouses, the better you're able to staff and operate them in an economy where labor is particularly hard to come by.
Right. Ibrahim.
So in my view, it's an industrial warehousing side just to allow these things to function.
A quick question, Ibrahim, in terms of the design, in addition to robotics, any design changes around driver amenities? The combination of drivers, rest facilities, break rooms.
Well, I mean, there's a need to have warehouses that allow for sort of a constant flow of trucks in and out. So if you think, again, if you were to go back, say 25 or 30 years or so, warehouses weren't something that necessarily needed to have transportation going in and out sort of 24/7. But that's very much the case now. So you have to, when thinking about some of these more modern warehouses, parking becomes a lot more important. The number of docks that you have to kind of get things onto trucks and get the trucks in and out as quickly as possible becomes even more important than it was before. And I say this like this is more than just sort of like a post-pandemic trend. This is something that I think really begins in the mid 2010s. Like it's around then when the speed of e-commerce becomes a much bigger deal. And so a lot of these trends that I'm speaking on, they're things that have been in play for several years now, but it's definitely where the industry is trending.
Right. All right. So a couple of questions, Ken. Trace Rosenberg, regarding DAT market conditions, how do we factor in the same load being posted by multiple brokers in the load to truck ratio, or doesn't it?
So in load to truck, there's a couple different things. There's no way to really scrub out the same load that multiple brokers are trying to cover, like what we would call like a non-commit or a kind of like a I'm working on it load. So let's just say there are 5 brokers that are all trying to cover a shipper's shipment, and whoever gets it first or whoever gets it cheapest gets it. They'll typically all 5 post that load to our board, and hopefully they'll find the carrier first, or whoever's willing to pay more, or however the economics of that particular transaction work out. One of the brokers will get the load. They'll end up moving, or none of them, right? The shipper may end up covering it through their expanded network, their own internal load board, et cetera, et cetera. So that's not really contemplated. MCI seeks to turn down the volume of overposting. So the same broker reposting the same load over and over. And we actually have new technologies that are going out right now that cut down on that as well. So they cut down on the behavior and as well as the measurement of it. So they allow you to use our APIs to go in and update load characteristics without reposting the load. So it's a long-winded way to say yes and no. There's kind of like an intrinsic behavior in the industry which makes it impossible to scrub out, not that you'd even want to, multiple postings of the same shipment. And then when it's clear and obvious, there are steps in our various products that we take to turn down the volume on some of that overposting behavior.
Excellent. And of course, it's as we've discussed on the show previously, Ken, it's still indicative of market behavior, right? The additional posting of loads, both on the way up and the way down in the freight market.
Yeah, I mean, that's kind of a longer discussion we probably don't have time for, but like if I were in the reason I prefer load to truck ratio when I was MCI didn't exist, but if I were in the industry and I had all the horsepower that I had at FedEx from a modeling and data science perspective, I would probably lean on load to truck ratio a lot more heavily, because that's, I don't know, there's this huge fallacy about separating signal from noise, but in a lot of modeling exercises, the noise is actually incredibly valuable to help get you what you want, right? So if you're only operating on signal, by and large, you're only sort of regurgitating back market norms and averages. So when I was in industry, I used load to truck ratio a lot because you typically see that over posting behavior, if we want to call it that, a lot more kind of a steep. It's not a linear shape, for lack of a better term, right? The loads get posted more and more and more and more and more frequently. Like hard to cover loads are harder to cover in tighter markets. I know that sounds like a really dumb way to explain something, but it's true. So, the last load on a Friday out of Chicago that's 45,000 pounds is hard to cover today when the markets are soft. But it's really, really, really hard to cover in 2021 when markets are on fire. And it's not some sort of like linear difference between how tight or loose those markets were. It is exponentially harder to cover. And I think that's the benefit of some of that extra signal you get with load to truck ratio. That's my TED talk anyway.
There's an adjacent question in there, I think, Ken, about the time frame of MCI in terms of accuracy from Clay. I think that's what he's asking. He's got current in inverted commas, so I'm not sure.
Yeah, so the beautiful thing so data scientists love metrics that have no empirical ground truth because they're never really proven wrong. So Ratecast is predicting the rate view rate. So if Ratecast says tomorrow the rate view rate is going to be 271 a mile and it's 251 a mile, the model was off by 20 cents. You as the customer can actually audit this, right? If you're really, really bored at work, you can go run a bunch of Ratecast strips and then come in every morning and see by hand how accurate or inaccurate the model was. There's no actual MCI, right? You can't drive to Harrisburg today and go find some billboard, some digital billboard that has that day's MCI on it, right? So MCI is a derived metric. And so therefore, it would be very disingenuous to claim accuracy with it because there's no really so we measure how accurate it is compared to how accurate we said it was going to be, but then again, that's more for our internal things to make sure the model's not going haywire. But if the question is how well does market conditions represent a market condition, we believe pretty high. We've derived that through customer research, through us studying the data, and through comparing it to other metrics out there, such as load to truck ratio or things like that. Right. So I hope that answers the question.
And just before we wrap up, one quick question, Ibrahim. One of the things we've seen with some of the warehouse development in big cities is pushback from communities where big warehouses have popped up right in the middle of suburbia. Is that an increasing or decreasing trend?
So I mean, it's definitely been increasing, but it's part of the fundamental sort of dilemma that the sector faces, and that the people that are looking for warehousing space, they want to get as close to the population as possible. Right. But the population doesn't like warehouses because warehouses brings noise pollution, right? It brings more trucks on the road, right. And all kinds of uncomfortable things that come along with having like a warehouse right next to your house. And so there's always going to be this kind of tension in the sector that and sometimes it works, sometimes it doesn't. I mean, there's if you're living in an area where somebody's looking to develop a warehouse, you want the jobs that come along with the warehouse. You also want the sort of the faster delivery times and all the other kind of things that come with the warehouse, but you don't want the negative aspects of it. Right. And so there are quite a few examples of times where like the local community bands together and they're able to successfully beat off a new warehouse development. Right. But there's also times where there's local pushback and it's just not enough to overwhelm the other kind of incentives that are at play here. Right. And in the end, you end up building the warehouse. I will say that it's increasingly difficult to build what we call infill locations. So like within sort of inside of urban areas directly. Industrial development tends to kind of spread out as time goes on. You find people locating further and further away from population, from like sort of the absolute center of the city, because it's easier to get through zoning for and other kinds of regulations there. But yeah, I just think it's part of the fundamental tension that's at play here, that you want to get close to the end consumer, but the consumers don't necessarily want the negative aspects to come along with warehousing.
Got it. Thank you.
All right, Dean, let's move us to plugs. We're running long. It's been such a great conversation.
Yeah. Sales chatter tomorrow, as always, 9 a.m. with Dan Deegan, Ryan Hobbit, and Jeff Dickinson. Connect with them on LinkedIn. We're on Landline now, 7 p.m. on Sirius XM tomorrow evening, channel 146 Road Dog Radio. Of course, next week is ACT Research 68th seminar in Columbus, Ohio. We'll be there speaking. And our show next week will be coming to you live from the conference. Our special guest will be ACT Research's Tim DeNoyer. Also look for our truckload volume index out next week. Don't forget the latest edition of Freightvine has Wall Street journalist Christopher Mims. And lastly, you can also find our market update at dat.com/market update. That'll be posted later this evening. Back to you, Ken.
All right, I want to thank Abraham for coming on. This has been terrific. I'd love to have you on at some point in the future to see if those vacancy rates are creeping up, or just to check back in the market, if you'd be willing to join us.
Thanks for having me. It was a real pleasure.
Yeah.
So I think the only thing looking a little bit further ahead that we have circled on our calendars is TIA, which is happening in mid-April down in Orlando. So I'm really, really looking forward to that. I'm seeing the agenda shape up and all the different industry presenters. I know that's a big one on the calendar for the brokerage community. And then Matt's, Dean, is...
Last week of March, we've got a number of speaking spots. There'll be a big truck show. We'll have a booth there. So it's the last week of March starting, and I think it's about the Thursday, Friday, the very last week of March.
Awesome. So lots of tremendous opportunities to get out and see folks. So come see us. I'm sure we have delightful pens and lanyards to hand out with all of the DAT swag. So we look forward to seeing you out there. Again, thoughts and prayers up there with our Michigan State community. Happy Valentine's Day. Don't forget the chocolates and flowers. We're going to sign off, and we will see you next week. Goodbye, everyone.
See ya.